Ladies and gentlemen, good day and welcome to KEC International Limited Q4 FY23 results conference call. We have with us today on the call Mr. Vimal Kejriwal, Managing Director and CEO, and Mr. Rajiv Agarwal, CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vimal Kejriwal. Thank you, and over to you, sir.
Thank you, Nirav. Good morning to all of you. I welcome you all to the Q4 earnings call of KEC. Let me start with an update on the overall performance and thereafter talk about each of the respective businesses and key strategic initiatives. The year commenced with unprecedented volatility in commodity prices and freight rates owing to the Russia-Ukraine conflict and ended with a weak global outlook characterized by fears of recession, high inflation, and high interest rates. Fortunately, in the second half of the year, commodity prices stabilized and freight rates have come down to almost pre-COVID levels. Notwithstanding these challenges, we have delivered a notable performance by achieving highest ever revenues, highest ever order intake, considerable improvement in working capital, and successfully accomplishing quite a few strategic initiatives across businesses. Our robust order book and geographical and business portfolio diversification is paying off well in the current environment and will be reflected in our performance in the coming periods. We have delivered a robust revenue growth of 29% with the highest ever quarterly revenues of 5,525 crores in Q4. Our T&D, civil and oil and gas businesses have delivered strong performances during the quarter. The margins for the quarter have improved by 50 basis points vis-a-vis Q3 FY23 to 5.1%. We have achieved a PBT margin of 1.6% and PAT margin of 1.3%. I am pleased to share that in SA Brazil, the business has delivered a positive EBITDA for Q4. We have successfully refinanced a part of the local loan in that entity and are on track to refinance the balance loans. We secured orders of over rupees 7,000 crores in Q4, a staggering growth of over 50% vis-a-vis Q4 last year. The orders have been largely contributed by the T&D and civil businesses. Coming on to the annual performance. We have delivered a robust revenue growth of 26% with the highest ever revenues of 17,282 crores for the full year. The growth is backed by healthy execution in both T&D and non-T&D businesses. We have delivered EBITDA margins of 4.8% and PAT margin of 1% for the full year. As conveyed earlier, the margins for the last 2 quarters have improved sequentially from 4.4% to 5.1%. However, the overall margins for the year are lower due to adverse commodity prices, higher logistic costs, and SA Brazil EPC performance. We continue to witness significant traction in order intake. Our order intake for the year FY23 stands at a record level of 22,378 crores, with staggering growth of 30% over last year. The order intake has largely been contributed by our T&D, civil and railway businesses, followed by cables and oil and gas. The traction in order intake has enhanced our closing order book as on 31st March to an all-time high of 30,553 crores, a robust growth of 29% vis-a-vis last year. Additionally, we have an L1 position of over 3,500 crores diversified across businesses. With this, our order book plus L1 stands at over 34,000 crores, which is largely divided equally between T&D and non-T&D businesses. We are happy that the order intake trend is continuing in FY24 with new orders of 1,017 crores announced last week. A focus on cash flows and working capital stands unabated. With dedicated efforts, we have brought down our net debt, including acceptances, by approximately 1,100 crores in the last 3 quarters against our guidance of rupees 500 crores reduction. Our debt level, including acceptances, stands below 5,000 crores at rupees 4,985 crores as on 31st March 2023, largely at the same level as last year, despite an increase in revenue of over 3,500 crores, a growth of 26% year on year. We have brought down our net working capital to 118 days as on 31st March 2023, a reduction of 19 days vis-a-vis 31st March 2022, against a peak net working capital of 148 days in September 2022. We are confident of a further improvement in working capital going forward. The interest cost stands at 3.1% of the sales for the year, owing to the steep increase in interest rates both in SA Brazil as well as in India and the elevated debt levels. We are confident that we will be able to reduce the same by close to 50 basis points in FY24 based on the reduction in the debt levels achieved in Q4 and the refinancing of Brazil loans going forward. The Board of Directors have decided to recommend a dividend of 150%, that is rupees 3 per equity share on the face value of rupees 2. Now talking about specific businesses. Our core T&D business has achieved revenues of rupees 8,809 crores for the year, a stellar growth of 27% versus the last year. The growth has been delivered on the back of robust execution across both domestic and international markets. The business has significantly expanded its order book with strong order inflows of over rupees 10,000 crores across India, Middle East, Africa, East Asia, and Americas. In India T&D, the business witnessed a good traction as it secured orders of over rupees 4,000 crore, a robust growth of 2.8 times vis-a-vis last year. I think such a growth we have seen in India T&D after a long time. The business forayed into emerging areas of digital GIS substations and HVDC terminal stations. It also expanded its customer base to include power producers and refineries, in addition to the existing clientele comprising PGCIL, state utilities, and private developers. The recent traction in orders and focus on the government on green hydrogen and renewables reaffirms our confidence in the strong growth of the India T&D business. In international T&D, we continue to expand our presence with multiple order wins in the key markets. We have also consolidated our leadership in the Middle East by re-entering Kuwait and securing large Gulf interconnection orders. We are witnessing a significant traction in tower supply orders, which stand at over 2,000 crores across the Middle East, North and South Americas. During the year, we have also reinforced our presence in the international cabling solution segment with orders in the SAARC region and Middle East. In SAE, we have secured record orders of over rupees 1,500 crores across Brazil, Mexico and US. With this, our order book and L1 in SAE has increased significantly to approximately 1,600 crores, comprising only of orders for supply of towers, hardware and poles, and no EPCs. We are witnessing a very healthy pipeline for lattice towers and poles from Americas. The robust supply order book, exciting business outlook and refinancing of local borrowings give us confidence of delivering profitable growth in SAE over the next few quarters. The overall tender pipeline in T&D continues to remain strong in both domestic and international markets, given the push for renewables and requirements for new transmission lines, substations and underground cabling. Our railway business has achieved revenues of 3,701 crore for the year. We continue to maintain leadership in the conventional area of overhead electrification OHE, having successfully executed almost 29% of India's railway electrification in FY23, the highest in the industry. The order intake for the business remains subdued at rupees 2,900 crores, despite a growth of 15% vis-a-vis last year. The business continues to diversify its presence in emerging areas and has secured maiden orders in the indigenous train collision avoidance system TICAS under Kavach. The business has also secured orders in conventional OHE, composite projects, as well as orders in the new areas of speed upgradation and technologically enabled areas of metros. During the year, the business has widened its clientele with the addition of multiple new clients such as Central Railway, South Central Railway, Western Railway, Chennai Metro, Gujarat Metro and MMRDA. With the increase in capital allocation in the finance budget, we expect the tender pipeline to improve going forward. We continue to focus on international opportunities across the geographies where we have an existing presence in T&D. Our civil business has delivered an impressive growth of 75% year-on-year with revenues of 3,319 crores. The growth has been delivered on the back of robust execution across all segments. The business continues to deliver consistently on the order intake front and has secured record order inflows of over 6,600 crores, including the single largest order in the history of KEC of rupees 2,060 crore in the water segment. During the year, the business strengthened its presence with significant order wins in the water, industrial, residential, public spaces and data center segments. The business has also expanded its presence in commercial buildings and logistic park segment. The uptick in order intake has significantly enhanced the order book plus L1 to over 10,000 crores, comprising of turnkey EPC projects across segments from marquee clients. We are confident that this business will continue to grow significantly going forward. In oil and gas pipelines, the business has delivered commendable growth post seamless integration of KECs for infrastructure. It has delivered revenues of rupees 483 crores, a strong growth of 2.7 times vis-a-vis last year. The business has secured order intake of approximately 500 crores with entry into new areas such as composite station works, which help to augment the pipeline laying capacity. The business continues to focus on widening its market by focusing on enhancing its pre-qualifications. The business has a strong order book and L1 of over 1,000 crores comprising government and private players. We are confident of scaling up this business in the coming years. In line with the government's focus on green hydrogen and associated renewable energy capacity addition of about 125 gigawatt in the country by 2030, we have started refocusing on the solar business. We have commenced execution of our largest solar project of 500 megawatt in Karnataka, secured last quarter. This project will utilize tracker-based technology, further enhancing our credentials in the growing renewable market. The modules for this project would be supplied by the client. Our cables business continues to deliver a good performance as with the highest ever revenues, order intake and profitability during the year. The business achieved revenues of 1,615 crores, a growth of 6% vis-a-vis last year. The business is also progressing well with the development of 10 new products this year, of which 6 products have been successfully commercialized. In a significant development, I am pleased to share that as part of a backward integration, the business has commissioned the PVC compounding facility in Baroda, which will help improving profitability. We are confident that this business will continue to grow in terms of revenue as well as margins. Last year, we had partnered with a global management consultant for a twofold business transformation program on world-class engineering and civil execution excellence. During the year, we have successfully completed the program to improve our engineering-led wins and enhance profitability across various businesses. As part of the civil execution excellence initiative, the team focused on developing end-to-end execution and project management processes, including digital initiatives such as equipment telematics, BIM, use of AI, ML, and analytics. In ESG, we continue to take several measures to transform our operations in a sustainable manner. Some of our key initiatives during the year include installation of solar rooftop at our Dubai plant, in addition to the existing solar rooftops at our Nagpur and Jaipur plant. With this, 20% of our total power requirement at these plants will be catered through solar energy. Installation of induction furnaces at all our 4 tower manufacturing plants to replace the fossil fuel-fired furnace with electricity or greener fuel. Various steps have been initiated across project sites for reducing energy consumption, GHG emissions, and conservation of water. I am glad to share that our progress on this front has been well appreciated, which is reflected in the improvement of our ESG rating by S&P Global DJSI and Morningstar Sustainalytics. Overall, we have delivered a good performance across various fronts. Significantly exceeded the revenue growth guidance by delivering a growth of 26% year-on-year against the guidance of 15 to 20%. Margins in the last 2 quarters have improved sequentially from 4.4 to 5.1. Exceeded the order intake guidance by achieving order intake of 22,378 crores, growth of 30% against our guidance of 18 to 20,000 crores. In SAE, we have closed all EPC projects and delivered positive EBITDA in Q4. Brought down our net debt, including acceptances, by 1,100 crores in the last 3 quarters against our guidance of 500 crores. This is despite a full year revenue growth of 26%. With traction in orders, we have built a robust order book plus L1 of over 34,000 crores. The outlook remains healthy across most of our businesses with the current tender pipeline of over 1 lakh crores. With a robust order book plus L1 and a strong focus on execution, we are confident of delivering an improved performance across both revenues and margins. Thank you very much. We are now open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Renu from IIFL. Please go ahead.
Yeah, hi, good morning, sir, and thanks for the opportunity. The first question is regarding your guidance and margin outlook. While you have mentioned that FY24 is expected to be better than 23, right, in hindsight, if you look 23 margins overall ending fourth quarter with 5% has been almost 50% lower than our normalized margins of 10% plus. So going forward, what is the outlook in terms of margin? By when do we expect double-digit margins to revert for the portfolio? And also aligned with this, can you throw some light in terms of the low-margin fixed-price T&D orders? By when are they expected to be broadly out and completed from a backlog?
Thanks, Renu, for your continued interest. And I think we maintain your record of asking the first question always, yeah? So anyway, let me come to the margins straight away. I think as far as the margins going forward is concerned, our view is that we should be seeing a 50 basis point increase, I think, quarter on quarter in the first half. So H1, I think we should show 50 basis points each, so we'll be around 100 basis points up by the time we reach Q3. Overall, for the year, we are expecting margins to be in the range of around 7%. So H2, in my view, will probably be around 8% or so. I'm sticking my neck out, but I think that's the way we are looking at margins based on the current, I'll say, market scenario. As far as the T&D orders are concerned, we had a few of them in the TBCB area, which is still impacted by GIB in some parts of it. We have completed, I think, one of them already, two are getting over now in this quarter, and the balance three, which should get over hopefully up Q2 or Q3, depending upon what happens on the land availability, etc. There are some issues still going on. A couple of projects are still on hold where there are large claims lodged with the client. So depending upon what happens and when the projects get completed, that would decide the sort of the impact on the numbers.
Right. So is it fair enough to say that while the non-T&D business is now nearing 9% plus margin, between 9 to 10% kind of margins, it is the core T&D business which is pulling down OPMs? And if possible, can you throw some color in terms of how has been the T&D profitability for fiscal 23 and expectations of fiscal 24?
So you're broadly right on the numbers, but I don't think we're 9% plus as of now, but close to that. I'll say slightly, maybe 100 basis points here or there. Okay, on the non-T&D. I think what you got to understand, non-T&D, around 600 crore revenue is coming from cables, which is at a lower EBITDA, but much higher ROCE margins. ROCE, okay. T&D has been very poor, okay. I'll say a low single digit. And that's what I can say on in the H2, and I do expect that will start improving from Q1 this quarter.
Sure. And then coming to the broad question of your order outlook, domestic T&D or overall T&D has done phenomenally well in FY23, and your comment suggested that the momentum should continue for 24. So how would your guidance for order inflows and specifically in T&D and civil business be, which have been the anchors for order acquisition for KEC?
So overall, this year we had an order intake of 22,000 plus. So next year or FY24 now already been, I think we are talking about 25,000 or so crores in the order intake. Okay. And also with the growth what we are having this year, I think we want to be very, very cautious and very particular on the order intake, because with 34,000 crores of L1 order book plus L1, we may probably be a little bit less aggressive on order intake by focusing more on the quality of the order intake.
Got it. Thanks, sir. I have more questions. I'll come back in the queue.
Please come back. Thanks, Renu.
Thank you. The next question is from the line of Parikshit Kandapal from HDFC Securities. Please go ahead.
Hi. Hi, Vimal sir.
Hi, Parikshit.
Yeah, congratulations on sequential improvement. My question is, in the start of the call, you said that the domestic T&D has, first time you are seeing 4,000 crores after a long time, you're seeing 4,000 crores of orders. So if you can just help us understand where's the demand coming from and your sense on T&D ordering domestic for FY24. You can also touch upon orders from utilities, industries, railways. So That will be helpful. So opportunities like Vande Bharat, high-speed rails, if you can touch upon that also, that will be helpful.
So largely, if you look at the order intake in T&D, it's coming somewhere on the back of green energy. Okay. Almost, I'll say, out of 4,000, almost 3,000 crores of orders must be in and around Gujarat. Around the Kavda area, the Ahmedabad, Navsari part and all that, where the large solar and hybrid plants are coming up. So most of the orders are from that area, including one from GIPCL also, which is coming in that area. There are a couple of other orders which have come from other TBCB operators. Okay, in fact, one which we announced this year in April was also from non-PGCL, but it was for a TBCB project. So we continue to see there are large number of TBCB schemes which are under bidding. But even today morning there was an advertisement for a GIS station. So we are clearly seeing a lot more business coming out. But again, I'll say mostly driven around green energy. Okay, that's the area where we are seeing. We are also seeing demand from private sector coming up for data centers, for refineries, and similar, even some of them for building large residential complexes where they want large cabling opportunities are there. So that's I think another piece which we are seeing in the domestic T&D. We are not too much focused right now on the states because of whatever problems we are seeing on the payments, etc. So we have sort of I would say defocused on most of the states. We are hardly working in a very few states. So state utilities is not a major growth driver for me. It could primarily be power grid and other private developers.
And on the railway side, sir, if you can touch upon the current electrification opportunity and the emerging ones, like, do you think that Vande Bharat will require a different electrification network and high-speed rail also, if you can touch on that?
So 100%, the Vande Bharat will definitely require much better tracks. The tracks have to be straightened out, the level crossings have to be shut down, overbridges have to be built, signaling has to be changed. The OHE will have to be changed. In fact, we have got a lot of orders now on 2 into 25. I think 5 or 6 orders we already have for those. So clearly, it's a matter of time that once the Vande Bharat trains increase in number, the spend on these things will definitely go up. The last year's spend has been a little bit disappointing. Also, I think what we did see was a significant increase in competition, okay, especially on the civil and composite projects, which had come more last year. The other big change, which in a way we were not able to manage well, was that most of the railway PSUs stopped giving orders and they became competitors, and the orders were all coming in from the zonal railways. So zonal railways have got a lot of local players, etc. So it did take us time for a company like us to adjust to that environment. So I think by now it's now falling in place. So hopefully we should see an improved order intake this year. Last year was a bit of a disappointment, but I think we are okay.
With the strong ordering expectations, so when you source your equipment, so I know towers and cables you will manufacture, transformers, substations, and other things, switchgears and also, are you seeing elongated delivery cycles? Are you seeing centers where the equipment manufacturers there is an elongation on delivery time, right?
So, Parikshit, what's happening is towers and cables, we have our own manufacturing, and we have 6 tower factories and 2 cable factories. So I think we are okay on that part where we can manage our priorities. As far as transformers and switchgears are concerned, there is a delivery issue, which in fact there is a delivery issue even in conductors, specific type of conductors. But I think with our relationship and with our vendor management, generally we have not seen a significant delay. Off and on there could be some delays on some particular type of equipment. If you want a 765 GIS, maybe there could be a delay or something. But generally, we have been able to manage. But yes, overall, if you look at the market, there is a strain on the supply chain very clearly.
Okay. This is the last question, sir, on the standalone business. So if I reconcile standalone and Concall, so there is a profit. If I difference net it off, there is a EBITDA positive about 77 crores. And so is there any reversal in any of the entities, international entities of provisioning? And if I have to attach it to the EBITDA margin, so the EBITDA margin in standalone is the lowest now at 4.2% this quarter. So this issue is largely only to the fixed T&D projects, or civil also we are seeing some pain?
No, I don't think it's a question of pain there. There has been some pain in T&D. Obviously, civil there is no pain at all. I think the issue which is there is in some of the earlier calls we had talked about our Dubai subsidiary, which is a tower factory, and also our EPC arm, which is under the Dubai factory. Both are 100% owned by KEC. So what's happening is that many of our orders for tower supplies and also all the orders in UAE, and also some part of it because of the fiscal benefits which we have and the duty advantages. This year I mentioned that our Dubai turnover is close to 900 crores, which and with I'll say that very healthy PBT. So all that would have otherwise a year back would have probably have been a part of the standalone, and that's the only reason why we see a lower standalone, as compared to the earlier years. That there is no reversal or any other issue, except for what Renu was talking about TBC project. There's some pain there, but otherwise all other businesses are okay.
Okay.
Thanks, Parikshit. We'll have to come back.
Yeah, sure.
Yeah. Thank you.
Thank you. Next question is from the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yeah. Good morning, sir.
Morning, Bhumika.
Good morning, sir. Good to see the debt reduction that we've seen over the last 3-4 quarters, almost 1,000 odd crores between 1Q and 4Q. Now, if I see the interest cost, it's actually risen quite sharply despite the decline in the debt levels. Clearly, some bit of it would have got to do with the increase in the interest rates. Now, as we move ahead, when we're talking of it to be about 2.5 to 2.6% of revenues to be the interest cost, this is talking of a very sharp decline on a quarterly basis versus the exit of 4Q FY23, which is at about 160 crores. What gives us the confidence that this will kind of come down, and what are the areas that will actually drive the reduction in the interest cost? Also, if you could talk about if there is further scope of, debt reduction.
So, Bhumika, I do not see much of debt reduction happening because we did not discuss, but we will definitely have a 15% plus revenue growth in FY24 again. Okay, so that would require some more working capital. So honestly, I'm not very sure whether we can reduce the debt further, keeping in mind the revenue growth. Okay, maybe what will happen probably is that NWC should improve. You saw that we already improved by a good number. Our target always remains below 100. I think we should be able to reduce by at least 8 or 10 days this year, from 118 to maybe 110, or maybe let's see what we can do. Our aspiration still remains below 100. So that's one part of it. As far as the interest is concerned, we had around 160 crores of interest this quarter. And if you look at our Brazil interest for the year, the Brazil interest is around 90 crores or so. Okay. So we do expect that interest will come down by at least 30-40 crores if we are able to, restructure those loans the way we have been discussing, either by way of, restructuring the loans or maybe some equity infusion from India where you actually borrow in India at a much lower rate. So that's one part of it. The second part of it is, this entire debt reduction largely has come in Q4. So clearly, you'll start seeing some impact happening in Q1 because a lot of people ask me the question saying debt has gone down, interest has not gone down. That's because most of the debt reduction happened actually in March. So there'll be some impact of it, and hopefully, I think the interest rate scenario, notwithstanding the Fed increase yesterday, should sort of settle down, where we should start seeing some improvement somewhere in the interest cost also. Also, with our international business going up, we should be in a position to leverage that and probably borrow a little bit more in foreign currency because the premium rates have come down to below 2%, etc. So it does make a lot of sense, saying that can we leverage our international business and borrow a little bit more on this. And I don't know, Rajeev, if you want to add something.
So I would like to add only one more point. That the entire impact of the rate hike cycle, which let's say in India got completed in first week of February by the RBI announcing 25 basis point hike. So that got over, and so that entire impact has come in quarter 4. previous quarter, the impact was coming gradually as the rate hike was happening. But quarter four has taken the entire impact of 2.5% interest rate hike cycle, which has happened over the last few quarters. So that is also one of the reasons that, the interest cost for this quarter is looking higher. And we are very confident that, with the reduction of almost 1,000 crore in this quarter, we should see a lower interest cost in quarter one, in the absolute number.
Okay, sir. So my second question is on the order intake that you spoke about, close to 25,000 crores for next year. You said that, we will be focusing a lot more on the quality of the orders. Now, if you could just elaborate here in terms of, you mean by margins, you mean by working capital, what exactly do you mean? And simultaneously also talk about, because obviously T&D orders are clearly picking up, and we've seen that in FY23 and the outlook remains fairly strong. How is the competitive intensity out there across segments like T&D, railway, civil, if you could just touch upon that?
So, our largest markets today are India and Saudi Arabia. Okay. So clearly in Saudi Arabia, we are seeing the competitive intensity going down and the margins improving slightly. I think that's one part. India, what we are seeing is that many of these orders are becoming very specialized orders, like a digital substation or 765 with specific conductors, etc. And where these are larger projects, the competitive intensity is also slightly down as compared to the earlier years. Okay, जो पहले मारामारी हो रही थी वो अब ये नहीं हो रही है. So effectively, I'll say in the bigger orders. Same thing applies in civil today. If you have orders of, let's say, tenders of 500 crores and above, you will have basically 3, 4, maximum 5 players. So clearly on the larger ticket size, we are seeing a less competitive intensity. But on the smaller ones, especially which have got more civil content, in the railways we have seen lot more competitive intensity. On the residential sector and all that, where we are becoming a little bit larger than what we had wanted to be, but there we are seeing very, very little competitive intensity with just 2 or 3 players in virtually across all these bids. What was your next question, Bhumika?
No, sir, just on the focus, when you said the quality of orders we'll be focusing on for next year in terms of a 25,000 crore intake. So will we mean to focus more on the margins, focus more on the working capital? Exactly when we speak about quality of order intake, what exactly do we mean by that? Any targets that we have in mind when we are bidding for the orders?
So I think there are 3 or 4 things. 2 you have already covered. Yes, working capital is very clearly one of the focuses there. They're saying if there is a large negative carry in the working capital during the project execution, or there is a very large retention element, etc., we are looking at it very seriously whether we want to even bid for those projects. So that's one part which is very clear. Profitability again is something which is now there on our I'll say much more focused manner, and clearly we have slowly started increasing the threshold profitability in many of the places where our concentration is becoming higher. Okay. Let's say, for example, I don't know whether it should be, but let's say for Saudi. Okay. Want to look at it and all that, then the number where we are quoting is becoming different. The third one is that with all the issues which we had on commodity, etc., we are again becoming very, very, very choosy on what orders, what is the risk on commodities, and whether, can I bid for something which I can hedge immediately if there is a price variation, or, because I'll give simple examples. There were tenders earlier which you were quoting on fixed price, but the prices are opened after 6 months. At that time, you were at the mercy after 6 months. If you are L1, then you would have to take the commodity at whatever price it was there after 6 months. So tenders like that, we have become very, very cautious whether we want to bid them or not, or even if we want to bid them, how much of, commodity risk we want to provide for. I think these are the 3 items. I don't know, Raji, anything else you want to add on the quality?
I think the working capital.
I think the fourth one is on the size of the orders. I think what we are realizing is that I think the number of projects which we are executing today is very, very large. So we are looking at reducing the number of projects which we are doing. So in some of the businesses, especially in civil and even in T&D, we have actually put a sort of a floor saying that below that we will not quote. I think there are 3 or 4 things which will help us in improving our order intake quality.
Great, sir. I'll come back in the question queue. All the best, sir.
Thank you, Bhumika. Thank you.
Thank you. The next question is from the line of Ashwani Sharma from ICICI Securities. Please go ahead.
Yeah, good morning. Thanks for the opportunity. So my first question is on
Ashwani, sorry to interrupt you. Your voice is not coming clear at all. May I request you to speak through the handset?
Yeah, can you hear me now? Is it fine?
Perfect. Yeah.
So my first question is on the working capital. So there has been improvement, but I, wanted specific updates on the railway where we had, GST payment pending. So what is the status over there? And also if you could, comment on the Afghanistan, we were on from where 150 to 200 crore. Have those payments come in?
So on Afghanistan, out of 200 which we were expecting, we got around 50 crores. The balance we have already signed agreement, so I think the money should come in hopefully within this month. So the 200 crores should be there. In the sense that we already got part of it already signed and sealed. So it's just a question of getting the money. As far as working capital is concerned, I'll let Rajiv answer. But as far as GST is concerned, we have any major issue now. The GST, since the inverted rate structure got sorted out, the GST settlements are happening, and it has been coming down, month over month. Maybe Rajiv, you want to come?
So basically, on the GST front, I would like to say that, a couple of quarters back, we had given a guidance of reduction of about 150-200 crores. So during the year, we have actually reduced, GST balances by roughly about 120 odd crores rupees from last year to this year. Obviously, from a peak level, if you look at what was there in June, from June to March, we have reduced almost 200 crore of GST accumulated balances. And this is on the back of inverted duty correction which happened in July, and that has helped us to reduce the GST balances, especially in railways. So railways, actually, on the working capital side, although payment from the clients it's still yet to improve, and especially we were expecting some payment in the month of March, and those roughly about 250 crore got deferred. But GST part has definitely improved in railways, which is about 100 odd crore rupees. They have reduced the balances. So on the working capital fund, I would say there are a couple of items which we are still working, especially on the railways and other companies, which should help us to further improve our working capital this year.
Yeah, thanks for the detailed answer. So secondly, on the standalone numbers, when you look at the margins, you did highlighted the rationale, but was there any legacy, was there any loss related to legacy orders during the quarter? And what is is there any share in the legacy orders in the current order book?
There is. Actually, we have talked about that we have got a few TBCB orders where there are losses which were there, and that's what has impacted the standalone, apart from the Dubai part.
So what was the quantum?
I don't have the exact quantum. I don't think I can give you right now. Maybe if you speak to Abhishek later on, he'll give you the numbers. But there are some more legacy orders which, as I mentioned earlier, we have completed a couple of them. Couple of them will get completed in Q1. And the rest will depend upon, at the client side, once we get the clearances, then those will get over. I don't know whether they'll be in Q2 or maybe Q3.
So just one last question. So in your opening remarks, you were talking about few strategic initiatives. If you could just, let those, what those be?
No, I think what we had talked about was, like in railways, we started getting into more technology-prone areas. That has been done. We got TCAS, we are L1 in some other segments which we have not yet got the orders, so we are not announcing them. We got 3 BLT projects. Then we finished our one of our large programs with an international consulting on improving our engineering. And that you can see clearly, the reflection of that is in our much larger wins in T&D. And also partly I'll say in civil, because we are also doing a lot of work on analytics and AI ML on the civil part of it. And that will clearly help us in improving either our margins or our competitiveness in the system, as well as execution.
Yeah. Thank you, sir. Thank you very much.
Thanks, Ashwin.
Thank you. Next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Good morning, sir.
Morning, Priyankar.
it was great to see such a significant level of deleveraging. So it was significantly ahead of your estimates. But my question is, so can you just give us some idea, like what is the level of debt at the Brazil subsidiary SAE? And you were highlighting that interest rates have gone up there. So what is the effective interest rate there? And since you were speaking of refinancing there as well, so what is the level of interest cost we should expect here, let's say, assuming that you complete your refinancing by the end of the first half?
Okay, sir, our debt is around 450 crores or so. 400 crores. So our debt is around 400 crores, $50 million actually in Brazil. Right now we are paying between 18 to 21% of interest cost there. Okay. So the base rate I think 13.85 or something is the base rate, and then there's a margin over that. And since we have we had a loss-making balance sheet there, we are almost at the higher end of the margin. Okay. What we are expecting is that by deleveraging and reworking and with some corporate guarantees from India, etc., the rate should almost come down to half. That's what we are, which is what the number which I talked about earlier, that the interest from 90 crores should come down by 40-50 crores. So we expect that the interest will start coming down, maybe partly in Q1, but definitely in Q2, etc. We'll see a significant reduction in the Brazil interest cost. Raj, you want to add something?
Yeah. So towards that, we have already done $20 million refinancing. So to that extent, 35-40% portion of the debt has been converted at at virtually 8% interest rate.
Oh, so should we see the benefits of that in the next quarter? Let's say this 20 million refinance. I mean 1Q.
Certainly.
Part of it will definitely come because we just did it at the start of the year, and definitely the full benefits will start flowing in Q2. And hopefully by that time we would have done some more.
Okay, well understood on that. The second part, like I just heard that you got something like 50 crores of what was due from Afghanistan, right? So any color can you throw on when you expect the balance 200 crores to come back to you? And what is the state of negotiations maybe?
No, I think what we had said was that out of our overall dues, our gross dues around 600, net dues around 200 and odd, 250. We had said that we will get around 200 crores in Q4 is what we had expected to get it. So out of that, roughly around 50 crores came in Q4. And the balance we were expecting, but unfortunately the agreement got delayed. The agreement has now been closed. So around, I think within May we will get another 150 crores or so. So the 200 crores which we had talked about earlier, that money will come in. The balance money which is there is from multilaterals funded, which is World Bank and ADB, where very intense discussions are going on. And I think we are fairly confident that by the year end we should get the entire money. But that's the way we are looking at it based on today's development. We'll also obviously keep our fingers crossed on what happens on the geopolitical side. But whatever discussions are there today with the multilaterals, I think they are also equally keen to close and move ahead.
And sir, one more question from my side on the railways payment. I remember there were the EPC project where there were milestone-linked payment issues. So, what is the status for that? So, is the fourth quarter improvement in working capital that we have seen such a sharp improvement, is it due to us achieving some milestones with railways and the receivables there coming down? If that is the case, or let's say, how should we see the working capital movement from here on?
So let me put it in a different fashion, Priyanka. In the last couple of months, railways has become cash neutral to us. Earlier, we had to put some money into the working capital, which we are now not putting. They are collecting enough to take care of their payments. Has the working capital come down? Maybe marginally. Okay. I think we are still facing issues. Some of them is because of the EPC, which now the projects are just getting over. Or I think some of them have got over, so those monies will come in. Also, generally, we have been seeing some slowdown in the payments, okay, which was more March and I think March and blues. Now I think that is getting resolved. So I think we will start seeing some improvement. And which is one of the reasons why Rajiv talked about saying that we'll reduce net working capital, etc. One of the levers for that this year is going to be the reduction in the NWC of railways.
So this year the focus is reducing the balances with railway, FY24.
Absolutely. Absolutely.
And so the last question from my side, can you give us a ballpark idea of what is the fixed price share of contract in your order book?
I don't have that number, but I'll tell you one thing is broadly, most of the fixed price contracts, wherever we had exposure to base metals, have already been hedged. So I don't see any rising from any of the new contracts which we have taken on fixed price. Okay, because what has also happened this time is that, as I talked about earlier to Bhumika's answer on quality of order intake, etc. So we were very careful on that. So I think all the fixed price contracts which we have taken now in the last financial year, all of them are fully hedged now, except for steel. Obviously, steel we can't hedge, but steel I think we have been seeing generally a stable environment, and we had also provided for some increase. So I think we are very comfortable on the metal pricing in all our new fixed price orders.
Okay, well understood, sir. That's all from my side. Thank you, sir.
Thank you, Priyanka.
Thank you. Next question is from the line of Jonas Bhutta from Aditya Birla Mutual Fund. Please go ahead.
Good morning, sir, and congratulations on the working capital improvement that we've seen. So, three quick questions. Firstly, sir, when we look at the subsidiary performance, which is basically Concall minus standalone, the performance of the Dubai subsidiary seems to mask the performance of maybe oil and gas and SAE. So if you can talk about how SAE performed at least at an EBITDA front in this quarter, and the backlog that it has of about 1,500 crores, as and when executed, what kind of margin band, at least at a bid price level, have you sort of bid at, and we should assume for the next one and a half year as this 1,500 gets executed?
So Jonas, the last question is easy for me. I think the bid margins are between 8 to 10% there. Okay, so I think going forward in SAE, at least on the EBITDA front, although the interest is still a big concern for us, I think EBITDA we are quite comfortable because they are all supply orders, and most of them, quite a part of that has been already hedged already. Okay, so that's one part of it. The second part on the EBITDA part is, I don't have the exact numbers, but it's marginally positive as far as both Brazil is concerned, and Mexico also has done well. So it will be I think $1 million or $2 million. I don't have the exact numbers, but it's not a big number, but it's okay as far as when you look at the turnaround from the losses. And as far as SAE Spur is concerned, I think Spur has been doing very well. And I don't have the exact numbers, but normally Spur we have been making a margin of around between 8 to 10%. I think that was the margin for this quarter also.
Understood. So because when we see the implied margins in the subsidiary, it works out to roughly 14%, which is considerably higher than what you mentioned in terms of SAE's potential and that for Spur. So was there a one-off in Dubai, or this is something that we should maintain in terms of steady state? On the 900 crores worth of revenue, what is the kind of margins we booked here?
So Jonas, if you look at the Dubai revenue, I'll say half of it was from tower supplies and half of it was from EPC contracts. Okay, tower supplies would typically be, I'll say, between 10 to 15% margins. That's the way we have been looking at tower supply. And also what happened was, I'll not call it one-off, but I think many of the orders which we booked after that, if you remember, if you look at the steel prices and a little bit, we had some gains in some of the prices, etc. And also logistics. I think the major advantage which we got in the Dubai supply was on the reduction on the logistic costs against what was considered in the tender. But typically, I think we should be at 10% plus as far as the Dubai is concerned. I don't think it will be at 15% going forward. Depends upon what sort of EPC orders we get and what are the margins there. Supplies would traditionally be around 10% plus. So you're right that Dubai has a major role to play in the numbers of the subsidiaries.
And what is the order backlog as of now, sir? There?
In Dubai, I don't know.
Well, so basically the tower factory is full for the next year. And the order would be roughly about 400 to 500.
It's going to be around 400. I don't have the exact, but it will be 400, 500 crores. Basically, there are 4 or 5 orders, couple of them in Dubai, couple of them in Abu Dhabi. So I think there are 4 or 5 orders. I Abhishek can give the full number, but it will be around 400, 500 crores.
Sure. So my second question was on the working capital. So if I look at inventory days, receivable days, they are largely we've maintained them at the average level of, say, maybe Q4 of last year. Where we've seen a massive reduction is in the other current assets and non-current assets. Any line item that you can point to, that has led to this reduction? I know Rajiv spoke about GST collectibles sort of coming down. I don't know whether that played a role. At least going through the annual report, one of the main line items there is due from customers, which is effectively contract assets. Has that come down considerably? And the second part that helped us was on the payables. We manage payables pretty well. So both of these are these things that are likely to remain in our favor even in FY24.
So, Jonas, Rajiv said, I think that there has been a reduction in most of the line items. If you look at the inventory reduction, if you look at the GST balance reduction, each of them have contributed about 150 crore rupees compared to the last year in March. Obviously, these numbers have significantly gone up during the middle of the year and especially at the end of Q1 and Q2. From there, the reduction is pretty sharp. Okay. So that's one. Even on the debtors days, if you look at the DSO numbers, DSO days have also come down by about 10 days. So obviously it is not enough. And we are expecting much more reduction on the DSO days side. So, but DSO days from last year March, it has reduced by about 10 days. So there has been reduction in many of the line items. Obviously, DSOs is something which we need to work more, and probably that's the area where we are working, and we expect more reduction in DSO days in the current financial year, and that will be again, from that reduction, whatever working capital gets released, that will be used for doing a growth in the current financial year, which is about 15% growth we are expecting. So that will get financed, and that is how the loan or the borrowing will not go up from here. In fact, our target is to, as Vimal pointed out, our target is to come down on the NWC days from 118 days as on 31st March to about 100 days, so less than 100 days. Let's see, we are targeting, aspiring to reach 100 days, but definitely there will be further reduction on that number.
Got it. Thank you and all the very best.
Thank you.
Thank you.
Thank you. Next question is from the line of Shalini from DSP Mutual Fund. Please go ahead.
Sir, hi, this is Vivek Ramakrishnan. Most of my questions have been answered, but let me pose one tricky one for Rajiv perhaps. One way of reducing interest costs is to keep your ratings higher, and ICRA has put your rating on negative AA-. They've said that key thing they're watching for is total outside liabilities upon net worth. So even if you increase payables, it gets counted there. So how do you expect the trajectory of this to go over the next 1 year? That's the only question from my side.
So basically, why they put us on the negative trajectory, you would have looked at the rating rationale. That was, they wanted to see the margin trajectory to go up. And clearly, in Q4, we have improved our margins by 50 basis points. And what we are, Vimal has just guided for another 50 basis point hike in the margin in Q1 and Q2 also. So I think from now onwards, our margin trajectory will be positive. And that we will be able to retain the rating at least, at the current level. I don't think that, margin, this rating should go down because we have achieved a large reduction in the borrowing also. So that will also work in our favor and in favor of the rating agency. So that will also help us to maintain the rating.
Absolutely, sir, and wish you all the best there.
Thank you so much.
Thank you. Next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Congratulations for a good set of results, and thanks for the opportunity. My first question was more of a bookkeeping question from my side. Wanting to get a sense of whatever 26% odd growth that you have reported in revenues, how much of that would be volume versus value, and maybe a similar number for your inflows as well?
Volume, I think most of it would be volume driven. Because there could be a little bit in cables, maybe, I don't know. But I think cable maybe the metals have been at the same time. So I think most of it would be volume driven. Yeah.
Understood. The second question that I had was on the water business. Now, as I see today, it's almost 20% of your backlog, if I'm not wrong, between 15 and 20. Whereas a few years back when we were having the discussion, water appeared to be a difficult field in terms of margins and in commercial terms. So what in your view has kind of changed for us to be becoming more aggressive in this line of work?
So Aditya, when earlier we were talking about water, it was almost like a different business. Today it's become a very different business with the central government thrust on, Jal Se Nal Tak and, water mission, etc. So the cash flows are guaranteed. The projects have become much more larger. The competition has become much more healthy. In fact, the water business is one of the reasons why the NWC has come down also, because the payments are, I think, one of the most prompt payments I have seen in EPC business happening in water. Okay. And the numbers which are about our order book today would be slightly, I think, it's almost 15%. We have around 3,000 or 4,000 crore order book actually on water against a total order book of 31. So 13% would be our order backlog today in water.
Understood. The next question that I had was on margins. I just want to get a sense from you, as in you had maybe 2-3 years of double-digit margins from 16 to 18, 2015, 2018. At which point of time your top line was at 10,000 crores or thereabouts. Now it's about 18,000 crores of top line. As you kind of keep on scaling up, is it difficult to get back to the 10% EBITDA margin level? Just wanted to hear your thoughts on that.
It is difficult. Let me put it this way, because once you keep on, which is why if you were there on the call earlier, we talked a lot about the quality order intake. Because, and I think the way if you look at our 10-15 year history, it has been a step ladder sort of growth where, for a few years we have had a much larger revenue growth and a lower margin growth. And the other way around is, if you look at from 2015, 2020, our revenue growth was flat and our margin grew significantly from 6 to 10%. So there is some correlation if the numbers go up very fast. But I think what we have to look here is that our numbers are now growing because we are getting into more businesses. So if you're trying to flog the same business which has reached maturity, then growth will definitely impact your margins. Okay. And now that we have civil and oil and gas, etc., I think it's not going to be a significant impact. The revenue growth will not have too much of impact on the margins. But I think as far as double digit is concerned, we are very clear that we are looking at double digit, and we had earlier also said, and again we have, I hope that by exit of FY24, we should be at double digit or close to double digit at the time of exit.
Sure. Just a last question from my side, and thanks for your response on that one. So you talked about competitive intensity in, let's say, Middle East actually going down. Is this an indication of good things to come from an ordering or an order growth perspective? Are you kind of seeing, let's say, next 1 to 3 years being pretty good in the Middle Eastern part of things?
I don't know about 1 to 3 years, but at least next 6 months to 1 year, I can very clearly see large number of tenders in the pipeline, especially in Saudi. And also we are seeing UAE also has started coming back into action, and at least every month we have started seeing one tender, unlike Saudi where you have at least 2 or 3 tenders every week. So clearly from 1 year perspective, I think it's great, and that's the reason why the competitive intensity is coming down, because everyone is now full. Okay. In fact, we have now started looking at not quoting many of the tenders because of various reasons, and also because we have a large order book. So clearly, it's a sign of good things on the tender pipeline.
Got that. I'll get back into the queue for more questions, but thanks for response and taking my question.
Thanks, Aditya.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Kaushal Dedia from Axis Bank. Please go ahead.
Hello. Thank you, sir. Most of my questions have already been answered. And congratulations on getting positive EBITDA on Brazil subsidiary, net working capital reduction, as well as sequential improvement in the EBITDA margin. So just one question from my side is on the dues of Afghanistan. So I heard that you got some 50 crores in Q4 and another 150 odd balance is expected in this month. So after this recovery of 200 of crores, what would be the net dues in Afghanistan?
On a net basis, it will be about.
Sorry, sir, I missed you.
On net basis, it will be about 250 crores.
Even after getting this 200 odd crores?
Yeah, after 200 crores, the gross number is 400 crores and net basis will be 250 crores.
I think you can talk to Abhishek to get a better hang of it. There will be a large part of the reduction of the money which are coming in will also go to the liability reduction. Okay, but there will be some reduction.
Okay, and sir, lastly on this Brazil SAE thing, the subsidy, we will not see any further impairment or anything now that it has turned EBITDA positive. Is that fair assumption?
That's a fair assumption. Okay. I don't see any reason for any further impairment. Okay. But the impairment calculation has got a lot of things, including the 10-year US yield and all that. If the yield becomes 5% or 6%, you have a problem with it. But honestly, I don't see any more impairment happening. No.
All right, sir. Thank you so much. Thanks.
Thank you. Next question is from the line of Hitin from Sequent Investments. Please go ahead.
Hello. Yeah. Very good morning, sir. Good morning, sir. Thanks for the opportunity. So most of my questions have been answered. I have only one question left. That's on tax rate. So what would be a tax rate in this year, sir?
So the tax rate, if you look at the standalone, FY24 you are talking about? FY24 it could be approximately 24%.
I'm talking about fiscal year FY24. Yeah, sir.
Yeah, it is 24%.
Sorry?
24%.
24%. Okay. And sir, you have guided 15% top line. That's on console level, right?
Absolutely, yes.
Okay. Thank you for clarity, sir. Thank you so much.
Thank you.
Thanks again. Thank you.
The next question is from the line of Yashika Pancholi from Sunidhi Securities. Please go ahead.
Good morning, sir. I just wanted to understand if there's been any cancellation in railway orders in Q4.
Sorry, I didn't get your question.
Just wanted to understand that for railway, have you had any cancellations in Q4?
Cancellation? No.
Okay, that is all. Thank you so much.
Thank you.
Thank you. Next question is from the line of Ravi Malhotra from JP Investments. Please go ahead.
Thank you, sir, for the opportunity. I had a question on the international business on T&D. Since we are focusing on this business, what would be the addressable market size and key drivers for the T&D business in international markets?
The international market, I think it's very difficult to define a size because we keep on adding countries, reducing countries, etc. But typically we look at 15-20% growth every year. Okay, last few years we have not grown. This year we have grown almost 50-60%. So going forward, we look at saying that 15-20% growth should happen. And mainly it normally comes the neighboring countries, SAARC, Bangladesh, Nepal, etc. And then Middle East and Africa. Those are three major areas where we look at growth. This year we have added Americas because we are seeing a lot of work happening in Americas where we do tower supply. So to me, these are the areas where we look at, and typically the market grows at that rate, 15-20%.
And sir, one last question on the green hydrogen project which we have. So the government has a outlay of about 197 billion rupees. So what would be any calculation? What would be the T&D opportunity?
We don't have specific numbers because we do not know where and what will finally come in. The talk has been that there will be large green hydrogen, large renewable projects for setting up of green hydrogen. Okay, because ultimately it requires green energy. Now, depending upon whether it is wind and solar, where it comes up, etc. But typically the talk has been 18,000-20,000 crores of opportunity will come in T&D on account of green, also renewable energy plants being set up, and for the transmission of that the power from those plants to the electrolyzer or wherever else it has to go. I think it's still, I'll say, a little bit too premature to look at numbers because we honestly do not know, although there's a huge government trust. We still have to see, large size hydrogen plants coming up. Whatever are coming up right now are pilot plants in refineries and other PSUs. But we have not seen major plants coming up, but in anticipation being major announcements on the renewable side. So we'll have to wait and watch maybe 6 months or 1 year down the line where this becomes much more clear, saying what would be the impact. But I think we are very positive that there will be a good impact for us, both on the P&D side and also on the solar EPC side.
Thank you, sir. That's all from my side.
Thank you so much. Thanks, Ravi.
Thank you very much. I now hand the conference over to Mr. Vimal Kejriwal for closing comments.
I think I'd just like to thank everyone for their continued interest in KEC. Thank you so much. Thanks, Nirav. Thank you.
Thank you, sir. Thank you very much. On behalf of KEC International, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.